Good morning. For Traders Exclusive, this is George Kachuk with RCM Wealth Advisors reporting to you from the CME Group trading floor in Chicago. Basically what I'd like to talk about this morning is the ongoing equity rally and moving averages. First, let me explain what moving averages are. Basically, it's the average price of the closing price of a stock over a specified period of time. So basically, on a daily basis, important averages are the 10-day moving average. And that basically is the average price over the last 10 days where the stock closed at. So some of the important moving averages on a daily basis are the 10-day, the 21-day, the 50-day, and the 200-day. Similarly, on a weekly basis, we like to look at the 10-week, which corresponds to the 50-day, the 30-week, which is about 150-day, and the 40-week moving average, which corresponds to the 200-day moving average. Now, why is this important is we want to look at a few things that go on, and these moving averages, first let me say, can be plotted on a chart, and most charting service will show you this. And what we want to look at when we look at these moving averages is its relation to each other, its relation to the price of the stock, and the slope of the averages. So for instance, right now, if we look at the moving averages of all the indices, whether it would be the S&P 500, the NASDAQ, the Russell, the transports, the Dow, what we see is a very orderly fashion, meaning the 10-day is above the 21-day, which is above the 50-day, which is above the 200-day. It doesn't get any better than that. Now, of course, this isn't predictive of anything, but it tells us the relationship of how strong this market is, meaning for the shorter time frame is acting better than the longer term, than the intermediate term and the longer time frame. Similar, we want to take a look at the slope of these averages. In an uptrending market, as you see, all these lines will be in an upward trend if you look at a chart. Now, when you start getting in trouble is when you start seeing these averages turn down. And finally, the moving averages can be used as support levels, meaning a lot of stocks tend to ride a certain moving average, meaning most stocks, they'll say above the 50-day moving average if they're in an uptrend, and once they maybe dip below it, it may tell you that stock's in trouble. And similarly, if it gets below the 200-day average, it tells you something's really materially changed about the stock in general. So what we can say is right now in this market, if we look at the moving averages, they're all an upward slope, they're all orderly, with the 10 days above the 21-day, which is above the 50, which is above the 200-day, and that's very good. Also that we're seeing support levels, meaning they're not breached, indices are above that. Now you can also use this when you look at an individual stock. For example, a stock like Facebook. Basically it's been above its 200-day moving average for the past 3 years. After this last earnings report, it fell through its 50-day, and now it's below its 200-day, and that's the first time we've seen that in 3 years. Now that doesn't mean it's an automatic sell signal, because again, these things aren't predictive, but it just explains to you where you are in context, where you are in the market, and what you may expect. Similarly, the 50-day moving average has turned down. Now some people subscribe to the idea of a death cross, and that would be if the 50-day crossed below the 200-day, meaning telling us that the sort of intermediate trend is much more dire than the longer term trend, and that's something to look out for. Similarly, if we start seeing the slope of the 200-day turn down, that's also another negative. So these are the kind of things we look for. So in summary, take a look at your moving averages at the general indices, at your individual stocks, and that may tell you something about where you are in this market. You can also use these to step back into the stock. For instance, a lot of biotechs have gotten hit pretty hard, and then they were below the 200-day moving average. And just recently, some of them are starting to bounce above their 200-day and 50-day moving averages. So that may tell you there's a change in trend. You can see that something like in a stock like Celgene recently just did that in November, and it's still above those moving averages. So as a disclaimer, none of these are buy or sell recommendations. Consult your financial advisor if any of this information suits you. This is just some information if you're a short-term trader. Some of these things you may keep in the back of your mind. So as we always say, let price and volume be your guide, and also use the moving averages. And everybody, I'd like to wish you a Merry Christmas, a Happy New Year's, and Happy Holidays. Probably won't see you until next year. Have a great trading week. This is George Kachuk with RCM Wealth Advisors reporting to you from the CME Group trading floor in Chicago.